Welcome back to another video by my finance partner. In our first video we spoke about general income tax rates. Now we're going to dive into a little bit more on capital gains tax, which is also another area of tax that affects a number of individuals. And we thought we would just give you a little bit of an explanation in terms of how capital gains tax works and what the rates are. So just very quickly, just to explain capital gains tax. Capital gains tax becomes applicable if you sell something for more than what you paid for it. Okay. There are certain exclusions like personal assets and that. We're not going to go into all those intimate details on this video. If you are wanting to look into that in more detail, please reach out to us. But in terms of the high level overriding principles around capital gains tax, that is what we're going to be hopefully explaining and giving you an understanding of in terms of this video. So again, just very quickly, coming back to where I started, capital gains tax is only payable if you own an asset and sell it for more than what you paid for it. Okay, then the capital gain is only the difference between what you paid for it and what you sold it for. So let's take a very simple, practical example. You have bought a motor vehicle in your business for 100 Rand. You sell it 3 years later and you get 130 Rand for the vehicle. The 30 Rand only will be the amount that is subject to capital gains tax, not the 100 Rand. Just a point to note there is if you have received other tax allowances, okay, on that 100 Rand, for example, wear and tear, which is the tax term for depreciation, then there would be tax consequences to that too. Okay, but again, we're not going to get into those sort of details here. Now, very quickly, in terms of how does the capital gains tax work and how much do you land up paying? As an individual, you will often hear people talk about 18% as the amount of capital gains tax. Okay, that's not strictly correct. 18% is the highest amount of capital gains tax that you will pay. You could, however, pay less. The way capital gains tax works is, as an individual, 40% of any gain is taxed at your marginal income tax rate. Now, in our earlier video, we went through the personal income tax tables with you and what that means. Very simply, how capital gains tax will work is, if you make a sale of an asset and you have a capital gain, it's added to whatever income you may already have. Okay, so let's assume you are earning 300,000 Rand a year, okay, and you make a capital gain on some shares or investment that you cashed in, and the capital gain is 50,000. Because you fall in this bracket, okay, you will pay the 50,000 will be taxable in that bracket at 26%, not at 45%. So your effective tax rate on your gain will not be that 18%, but a much lower percentage. Okay, just very quickly, how do you get the 18%? 45% is your highest tax rate, okay, and only 40% of the gain is being taxed. So 40% of 45% gives you the 18%. Okay, so that's on the individual side, very high level how it works. Remember, only payable on the amount that exceeds the cost of what you pay for an asset that is subjected to capital gains tax. Okay. If we look at a company, 80% of the gain is taxed at 27%. All right, that's the company tax rate. Again, I just want to draw your attention back to a previous slide that was shared with all of you. If you as the shareholder have sold something, like you have an investment in your company and you make the capital gain, to get the money in your hands, you still need to pay a further 20% in order to receive the cash from the capital gain. Now that's very important to understand, because when you do the calculation of the capital gain, you're going to find that your capital gains tax rate is a lot higher in the company. You're first going to pay 27% on 80% of the gain. So the gain is double, but your tax rate is potentially less. And then with the money that is still left behind, if you want that in your hands, you are going to need to pay dividends with withholding tax to get the money into your hands. Okay. The last one is just on the trust. The rules around the trust, same percentage as your company, 80% of the gain will be taxed, okay? And the trust has a flat rate of 45%. So you're going to pay double the amount of tax in the trust for a capital gain as what you will in your personal name, because 40% of the gain versus 80% of the gain in the trust. Remember though, if we go back to one of our previous slide to you where we spoke about trust tax, you are able to distribute the capital gain, and in which event the gain will become taxable in the hands of the beneficiary. So it doesn't mean that the trust will have to pick up the capital gain. However, if you want to leave it behind in the trust, then you are potentially in for 36% of tax on the capital gain versus a maximum of 18% in your personal name. Okay, so very high level summary of how capital gains tax works, and hopefully an explanation in terms of what it means. If you do want more detail or require more information, please, we urge you just to reach out to us, and we'll gladly take you through this in more detail. But these videos are aimed at just giving you a basic generalist understanding in terms of what the rules are, so that you have a basic understanding in terms of what it could mean for you. We thank you, and we hope that you found this video informative and it assists you. And as we said before, we are here. Please just reach out to us should you want more information.